There's a retail revolution underway in private markets. Traditional fundraising has slowed, putting more focus on wealthy individual investors. Ares has been at the forefront of this trend, offering alts to retail for 2 decades. CEO Michael Arougheti sat down with us to discuss the growing popularity and whether it leads to growing risks. This is Inside Alts. So you just announced that you're increasing your AUM targets, which were already large, $750 billion by 2028. That's what you said last year. And now you're upping that by about $25 billion. What are the key drivers of increasing your targets, especially against this backdrop that we know has been a little difficult from a fundraising standpoint for the industry?
Yeah, look, I think the good news is Ares is growing broadly across each of our segments and distribution channels. This specific revision is largely just driven by what we're seeing in the wealth management channel. Huge momentum, broad product set, and just as we sit here today, the pace of growth there just has us already confident that we're going to exceed the initial target.
So that is really fascinating because you already have AUM across 8 semi-liquid products that crossed $50 billion recently. Yep. So $25 billion on top of that and on top of what you've already announced. So you've been in this space for several decades, largely through BDCs, now different types of semi-liquid vehicles. How do you see the evolution going, and what do you think is the key contributor to all of this momentum that's leading you to up these targets?
Obviously, wealth is getting a significant amount of attention now, just given the growth in demand coming out of that channel. I think the growth we're seeing is a confluence of a couple of factors. One is its buy-in from the financial advisor community, understanding that alts have a meaningful role to play in their clients' portfolios. It's recognition by folks like Ares that this is an underserved customer set, and that granting access to these types of products is valuable to us for growth, but also valuable to the client. It requires a huge investment. So we've been in the retail alt space for over 20 years. As you mentioned, ARCC, we launched in 2004.
That was before your IPO of Ares.
Yes, yeah, fascinating.
You could invest in that
fascinating.
Before.
But what's changed is now the quality of the product, the scale of the product, the investment that we've made in servicing the product. So we have about 185 people globally in 10 offices that are constantly working on product development, product servicing, advisor education, and client education. And I think that educational piece is a huge part of the growth story here. It's this demystification of alts and private markets investing for the end user.
Can you explain what that value proposition is? Because it's not like a 60-40 portfolio of liquid assets has done horribly, especially if you're more tilted toward equities recently. So what exactly is it that you feel like investors can't get from a traditional portfolio of stocks and bonds that they need to add alternative assets to that portfolio?
I think it's a combination of access and then outcomes. So just if you think about access, it's very difficult to access most corners of the alternative space in public form. And when we talk about alternatives broadly, you're talking about private real estate, private infrastructure, structured finance, private credit, and all things in between. There's just no logical entry point for the mass affluent or high net worth investor to really get that in the public markets. That's number one. Number two, when you look at the structure of the public markets, right? So if you take the public equity markets, there are 4,500, give or take, publicly traded companies. The market cap in the public equity markets is highly concentrated in the top 10 companies. And so while there's access and liquidity and return, it's actually pretty difficult to navigate diversified portfolio in the public markets. So I think when people start shifting to privates, they're looking for a couple of different things. We see a real hunger for durable yield and income, particularly given the aging demographic, and so things like private credit or yield-oriented real estate product really resonates. I think they're looking for diversified and non-correlated equity exposure, so private equity, real estate equity, et cetera, and there's a lot of tax advantage structurings that you can get in the private market that don't exist in the public market as well.
Yeah.
So I think in this conversation, it's not private replacing public, it's really just private becoming a more meaningful portion of a client's investable assets.
Yeah, no, it sounds like the diversification element is really important too, just as you mentioned. The disappearing public markets, as some have alluded to, and kind of generating that through the diversification that you get with the many more private companies that are out there. In terms of competition, wealth is... Ares isn't the only firm that has kind of caught on to and is growing their wealth business. There are a lot of them out there. What do you see as kind of the overall impact of that? And I ask that against the backdrop of concerns surrounding, maybe some bad behavior, putting poor performing assets into the wealth products and, reserving them essentially for retail, which may not pay as close of attention. Are you concerned that everybody has gotten on this wealth train, both from a competitive standpoint and from a reputation standpoint?
No. Yeah, I think the reason it's growing now is you have the highest quality, largest global managers bringing institutional quality and institutional adjacent product into this market in a way that they hadn't before. So this narrative of weaker product being reserved for retail is just not true. I do think that there are appropriate concerns that any time you're bringing product to the retail investor or the individual investor, it comes with different risk from a regulatory perspective, and so theoretically if there's underperformance in the channel, it may have a higher impact than if you underperform in the institutional market. But I think that's more of just a what does it mean for investor appetite as opposed to challenging the long-term growth opportunity in the private markets. A lot of people are looking at this opportunity set right now, but it's very difficult to access because, like every other corner of private markets, wealth is moving to scale. So if you actually look at who's raising capital, it's the large platforms that are global, that are multi-asset, that can make the investment in product development, seeding products, origination and portfolio management to deliver the product, and then the wholesaling and service infrastructure. And when you actually go through the math, what you're going to find is, unless you have confidence that you're going to get to $10+ billion, it's a really difficult investment to make. So not surprisingly, in very short order, we've seen a very high concentration of assets raised and assets deployed in the hands of the top 10. Yeah, and I'd expect that to continue.
So how does it work deciding what goes into an institutional portfolio versus what goes into a retail and wealth portfolio? How do you dispel that criticism that basically the illiquid underperforming stuff is going to go to retail and all the good stuff is going to go to institutional?
I don't know how other firms do it, but the way that Ares manages it is that we actually allocate our investments based on available capital. And so a lot of the investments that are finding their way into our institutional client portfolios are also finding their way into our wealth product. And so they're growing together. That has always been a cornerstone of how we've approached the growth opportunity here. And if you look at the dollars raised, we're always marrying our wealth product with what we would call a core flagship institutional product. And the reason for that is one of the challenges in growth and wealth is it's just more pro-cyclical than the institutional market, meaning when you get a dollar, you have to invest the dollar, whereas when you manage institutional money and drawdown funds, you can actually opt out of a market, and you give that opportunity set away when you grow in wealth. So our early learnings have been that if you really want to grow well through the cycle and deliver durable performance, you have to have the dry powder and the flexibility that comes with the institutional fund and marry it with growth and wealth.
That seems easier to do with private credit or direct lending than it would be with private equity. Is that right, or is it about the same?
I think it's the same. The way that we've approached private equity to date is our wealth product is more geared towards the secondary market. And again, if you think about what the high net worth client or the retail client is looking for, they get high diversification and no J-curve issue by investing in highly diversified secondaries portfolios. And so while that tends to give up a little bit of that asymmetric upside that you get investing directly in private equity, it's giving the end client what they want.
Yeah, past the point of the trough in the J.
That's correct.
Once you get in there. What about 401ks? You know, when we talk about retail in this context, we're talking about high net worth individuals, typically those who are finding their way to Ares through a financial advisor. But there's been an executive order surrounding 401ks, urging the government to look into those and to see if they're an appropriate part of a retirement portfolio. How do you feel about that?
I think it's fantastic, and again, putting aside just the current conversation or light that's being shined on DCs, retirement portfolios already have meaningful exposure to private. So in a world of defined benefit, the largest pension plans on the planet all have meaningful exposure to alts. So it would make sense that if it's good for the investor and the plan participant to own it in a DB plan, then they should own it in a DC plan, right? That makes perfect sense to me. And I think it's more just, again, about continued access to investment outcomes that are differentiated. That being said, we have a long way to go before that becomes a reality. To go from an executive order to actually having scaled product in this market, I think there's a lot that needs to happen. You need to see rulemaking. You need to potentially see a change in law. You need to see those two things then lead to an increased tolerance for risk on the part of plan sponsors. And then you need to see the entire alts ecosystem coalesce around this distribution channel as an area for growth. I think all of that eventually will happen, but I think it's years away, not months away. The other thing that we try to stay focused on is it's not an either or. It's not DC opens up to alts, or not, and it affects our business. The reality is it just diversifies our distribution opportunity. I think we're going to hit our growth targets whether DC opens up to alts or not. You would just see a different allocation of those investments into the different segments.
Interesting. So when we talk about the increase in your targets by 2028, that additional $25 billion from wealth, that does not even account for the potential opening up of 401ks, and that would just be upside from there, essentially. What, in terms of the regulatory changes that are needed, I know a lot of people have thrown out the litigation risk issue, and this idea that if 401k plan sponsor is paying high fees for something and it doesn't deliver, they open themselves as a fiduciary to certain litigation risks. Do you see that regulation?
That is the biggest issue, and that's where the regulatory change would need to happen. It could come through Department of Labor pronouncements and rulemaking, which would have some impact, but I don't actually think that you'll see change behavior until there's a change in regulation. And the challenge with that sector, which is almost to the disadvantage of the end client, is it's very, very fee sensitive. And the narrow definition of fiduciary duty is cost, not what is my unit of return delivered for that cost. And so almost by definition, structurally, the market is not geared to alts where fees are higher, but you pay for a much higher net return. So until you give the plan sponsors that comfort that they're free of litigation risk for having not pursued their fiduciary duty, I think it's going to be hard.
Which I guess is not the case for pension plans.
Not the case for defined benefit plans. They have similar concerns, and you do see some of the large state plans very fee sensitive, or at least spending more time understanding the cost for the return that they're getting. So that's part of the landscape, but just not as prescriptive.
You've talked about deal making. And you said for a long time that you expected a pickup in the second half of this year. We've seen a pretty big pickup in deal making. What does the pipeline look like from here? Do you expect this to continue? Do you expect M&A to come back in a big way?
I do. We're seeing it. Our private portfolios and pipelines are all showing higher levels of activity. We started talking about this earlier in the year. Obviously, we took a pause in April, and the pipelines have been building. I think the combination of certainty and clarity on tax and fiscal policy is helping. I think that the beginning of a rate cutting cycle is also helping, and then just the weight of money, candidly, is a big part of it. You have a lot of private equity dollars that are in the ground that's aging out, that wants to transact. You have healthy corporate balance sheets with growing earnings. Cost of capital is coming down. They want to transact. So, yeah, everything we're seeing would indicate that that's going to continue through the end of the year.
Yeah, it feels like the bid-ask spread concerns that took place from the 2021 period to now have somewhat alleviated, especially if the cost of capital is declining. I think companies will be able to agree on price?
I think that earnings growth has helped because over an 18 to 24 month period where you had M&A volumes low, companies have actually been able to grow into their multiple a little bit. And so you're right, the bid-ask spread is much narrower now.
How is direct lending impacted by all of this? Because on one hand, this space has raised a lot of money, and there hasn't been as much M&A activity, so it's a good place for that money to go. At the same time, you talk about the lower interest rates, and I'm just curious your thoughts on what that part of the cycle means for this asset class, which has really exploded in popularity as rates have been higher, or at least higher for longer.
So we've been in the direct lending business for 30 years through different rate cycles, economic cycles, credit cycles, presidential administrations, and the reality is the asset class delivers a durable excess return to the liquid alternative, loans and bonds. Typically 150 to 300 basis points. If you actually look at where the private credit direct lending asset class is right now, we're actually closer to the wides than the tights. One thing that people don't appreciate about private credit is it's not just base rate, it's base rate plus spread, plus fee, plus call protection and other things. And generally what happens is when rates are coming down, it's in response to weakening economic conditions, which means that your credit spreads tend to widen out. And so it's much more dynamic than returns fall out when base rate comes down, which is why you tend to be in a pretty narrow range of outcomes. So we're not of the view that we're going to see weakening appetite for direct lending in the investor community because of that phenomenon. And on the client demand side, the private credit solution for borrowers is still taking meaningful share from banks in the capital markets.
And what about health of those borrowers? Because, they've been able to kind of withstand the higher rates, it seems like, at this point in time. There were a lot of people who said, if rates stay high, a lot of these borrowers of private credit will see some issues because it's floating rate, and that hasn't really transpired in a very public way, right? Which I know you've been saying for a long time.
We were supposed to have a recession 2 years ago, and here we are. Again, there's a misunderstanding about what private credit is doing in the market. I think it's fulfilling two roles. One, it's actually helping reduce volatility in the liquid markets just because there's more consistent capital available, so that when you're seeing volatility, they're able to come in and actually dampen the volatility in the liquid market. I think that's been a big benefit. And two, because they're typically being made in longer dated funds with dry powder in them, they are able to work through problems in a way that the liquid markets aren't. So when your securities don't trade and someone can't come into your capital structure at a discount to par and agitate for outcomes, it just gives a borrower and a lender much more degrees of freedom to work things through. And the third thing, which I talk about a lot but I can't emphasize enough, most of the private credit asset class, whether you're talking about corporates or real assets, is underpinned by a significant amount of institutional equity. And when you look at, as an example, Ares' private credit portfolios in direct lending, they're sitting at roughly 45% loan to value across everything that we do. Said differently, there's an institutional equity investor who has underwritten the same risk at the company level that we have, that is subordinated to us to the tune of half of the capital structure. And so what's happening now is even when there's pockets of underperformance, the equity is so incentivized to make sure that they're working with the lender and the company, to protect their value, that I just don't think that you're going to see the high level of defaults, even if we see earnings recession that people are accustomed to seeing in prior credit cycles.
Yeah, the capital structure is a good point there. You have investments in more than 3,000 middle market companies, 500 million square feet of industrial, logistical, real estate space. What are you seeing with regard to the macro environment with that vantage point? Because we see what we get from those 4,500 publicly traded companies, the government data, any other type of alternative data we can get. But I want to hear your perspective because it's unique and it's a subsect of the economy that isn't as public. So do you feel like there are cracks forming in the labor market, inflation, stickiness?
Not really, and this is why we've had such high conviction over the last number of years that we weren't heading towards recession, that rates would stay higher. We're constantly mining that data, and as an example, if you look at EBITDA growth in our U.S. corporate book, it's been 12 to 13% year-over-year growth. If you look at NOI growth in our real estate portfolios, you're seeing similar trends. So there's nothing that we're seeing in the portfolio today that would indicate that there's trouble ahead. That being said, the anxiety in the market around stickier inflation, weakening job market, inflationary impact of tariffs and fiscal policy, those are real concerns. So I think you have to be open to that forward reality, resulting in economic weakness. But as we sit here today, we're just not seeing it.
Does that concern you then if the Fed is cutting rates?
I like the way that they described it as kind of an insurance risk management cut. I think one of the other reasons for optimism, the Fed has a lot of tools in the toolkit now, right? That you just mentioned, most levered borrowers have been through the worst of the rate cycle. Those that have survived have probably made appropriate structural changes to their business or their property that are now going to be a net margin benefit to them as rates come down. And to the extent that things get weaker, there's still significant opportunity for rate cuts, and there's a lot of balance sheet flexibility that exists as well. So I actually feel like we're pretty well positioned right now.
Another area that's been propping up growth in the economy is data centers. You have been raising a lot of money for data centers in particular, and for digital infrastructure. What is the key driving force, just this AI boom that we're seeing, and why does private credit and direct lending serve a unique role in that?
I would just to zoom out on a second, because data centers is getting a lot of attention, appropriately so, and I want to make sure that we really cover that.
Describe what that is.
Yeah, and I think that there are misperceptions in the market about what that is and what it isn't, but generally the way that we think about thematic investing here, whether it's real estate or infrastructure, we want to invest in the new economy. That means digital infrastructure. It means industrial real estate because of the growing penetration of e-commerce. It may mean life sciences and student housing to, capitalize on the knowledge economy. So everything that we're doing in real estate and infrastructure is geared towards really understanding where the growth is. Data centers is obviously a significant growth area, but it's going to be a growth area whether the AI revolution turns out to be what we all think it's going to be or not, just because the core demand for cloud computing and data consumption will grow for the foreseeable future to meet the supply of capital. I think one of the biggest challenges that exists right now in the data center space, in the capital markets, is there's just not enough dollars in the market right now to actually fund the pipeline. So where private credit is coming in is they're now able to come in with large-scale capital solutions to sit next to the bank and insurance solutions that already exist and be a liquidity provider.
That's surprising to hear you say that, because some have said that the data center boom is akin to a bubble. But you say there's not enough dollars chasing this space.
I think you have, again, it's all depends on your perspective. So if you think about what we're doing, we are focused on large-scale data center campuses. So, for example, the one that we just raised capital behind in Tokyo is a 250 megawatt campus with a investment-grade hyperscale counterparty with a long-term, well-structured lease. That is a wonderful place to be investing. I think if you're investing in secondary or tertiary markets without defined counterparties, away from the hyperscaler ecosystem, that starts to get a little, scarier. There's just more opportunities for risk to enter the picture. So again, not all data center investment opportunities are created equal. I think, again, similar to what we said in wealth, those that will quote unquote win will be the scale players, because that's where I think the quality exists and you're actually able to get paid excess return for the scale, right? And so the scale is a huge barrier to entry, and there's only a handful of people in the market that can actually bring that capital solution to bear.
So the scale players being the hyperscalers,
it's
or
the combination
scale
of the hyperscalers, the large-scale alternative asset managers, some of the large insurance company balance sheets. So when you're seeing the amount of capital that's coming in, you're beginning to see a lot of the same names popping up in this very specific part of the opportunity set, and I think that will continue.
Yeah, because they need big checks, and they need them very quickly, and they need them.
And they need flexibility in the capital structure. And even the banks, who have a real appetite to fund digital infrastructure development, run up against capacity issues. So there's even been an opportunity that we've identified in our asset-based finance business, where we're working with the banks on SRTs and portfolio purchases to help them create capacity to further their lending into the digital infrastructure ecosystem.
Lastly, because this is inside alts, and education is such a big component of this growth in alternatives and in wealth, what do you think is the biggest misconception that people who are new to alternatives have about what alternatives is?
There's really nothing alternative about what we do anymore, right? And I think that the nomenclature alone seems to imply that we're doing something different than people are used to. So the way I always try to, reorient people is, you can take equity risk and you can take credit risk. And when you take credit risk, you can take investment grade credit risk or sub-investment grade credit risk. You now have the opportunity to take those exposures in liquid form in the public markets or in illiquid form in the private markets. And depending on the investor and depending on the investment, both could make sense for anybody. So ultimately, this is about choice, access, differentiated outcomes, but whether a company chooses to borrow in the syndicated loan market or directly from Ares, the company is the same. And I think the biggest misperception is that somehow or other the private markets are creating investment exposures that otherwise wouldn't exist, that we're creating demand for capital that otherwise wouldn't exist, as opposed to just understanding this is the natural evolution and innovation in the capital markets that we've seen for generations.
Excellent. Mike, thank you so much
Always
for taking the time.
With you.
Really appreciate it.
Thank you.